Today, we are walking straight into what feels like the financial equivalent of a high wire act.
It really does. There's a lot of tension here.
We've been handed a stack of analysis reports, all focused on one really volatile stock, HIMS and Hers Health. That's ticker HIMS.
Right.
And it's a company that has market watchers, either, well, terrified or ecstatic. The big question being raised is pretty hard to ignore.
Is it the next GameStop?
Exactly. Is HIMS potentially setting up to be the next GameStop?
And look, it's not just a provocative question for the sake of it. It's being driven by some serious and frankly painful volatility.
Yeah.
You've been watching the charts. You saw that shockwave. The stock recently closed down over 6%, landing around, what, $31.69?
A drop that big, it just screams, get out.
Normally, yes. It often signals a collapse. But the analysis we're looking at suggests a very different reading. For anyone tracking unusual market opportunities, this dip is being flagged as a potential bear trap.
A bear trap. Something to force out the weak hands right before a big move. So our mission for you, the listener, is critical. We're going to unpack the engine of all this volatility.
Which is the massive short interest.
Right. And we'll put the pieces together to figure out if this recent price drop is a launch pad for a rally or if it's, the sign of a much longer slide.
To do that, we have to start with the basics. The foundational mechanic here is the short squeeze setup.
Okay.
And that all begins with defining the single most important metric in this whole conversation: short interest.
Let's define that really clearly, because I think for a lot of people, the idea of betting against a company is still kind of counterintuitive.
It is. So simply put, short interest is the total number of shares that have been borrowed from a broker and then sold immediately on the open market.
Okay, so they're selling something they don't own.
Exactly. The people doing this, the short sellers, are making a very explicit bet. They believe they can buy those same shares back later at a lower price, return them, and pocket the difference.
But the key part, which I think people miss, is they have to buy them back eventually.
That's the critical point. Every single one of those borrowed shares represents a forced future buyer. If the price goes up instead of down, they lose money, and they're eventually forced to buy back or cover their position.
And this is where the HIMS story it goes completely off the rails. The analysis highlights a number that's pretty jaw-dropping.
It's huge.
The short interest on HIMS is a massive 31.39%.
And that's of the available shares, what we call the float.
Right, the float. Let's just clarify that for a second. What exactly does the float represent here?
The float is just the supply side of the equation. It's the number of shares that are actually available for you and me to trade on the public market.
So not shares locked up by insiders or governments?
Exactly. For HIMS, that's about 205 million shares. So when we say 31.39% of the float is short, we're saying almost a third of all the tradable stock is being held by people who need the price to fall.
That's an astonishing ratio. What does a number like 31% really tell us about what the market thinks of the stock?
Well, it tells us two things. First, you have to put it in context.
Okay.
Anything over 10% short interest is considered high. Over 20% is considered extreme. So at 31%, this is what analysts call a crowded trade.
A crowded trade. So basically everyone is piling into the same bet.
Yes. A huge amount of capital, institutional and otherwise, is leaning heavily to one side, the short side. And second, and this is more important for the volatility, it creates inherent instability.
It's a powder keg.
That's the perfect word for it. It's a powder keg waiting for a match. The analysis even mentions the historical context, GME, AMC, and examples of what happens when that match gets lit.
And that match is usually some unexpected good news, right?
A little bit of good news, and earnings beat anything. The short sellers have to panic buy to cover their losses. That buying pressure pushes the price up, which forces more short sellers to buy, and you get that feedback loop.
The short squeeze that sends the price, as they say, parabolic. So the setup is clearly there. HIMS has the short interest level. But those other stocks, GME and AMC, they were seen as companies with, let's be honest, declining businesses. Does HIMS have any real foundation?
And that is the absolute crucial distinction here. This is what shifts our whole focus over to the fundamentals of the business.
Because it's not a meme stock.
The bulls argue HIMS is fundamentally different from a, quote, junk meme stock. Why? Because it's a profitable, high-growth company in a massive and expanding sector, telehealth and personal care.
Let's get into the numbers then, the engine behind the company. The Q3 figures highlighted in the analysis are, well, they're genuinely strong. We're talking revenue growth up 49% year over year.
Which is incredible growth.
That's nearly $600 million in revenue. That kind of trajectory suggests massive user adoption and, that the product fits the market.
It does. But there's another number that really makes HIMS an outlier, the one that elevates it beyond that meme stock category.
The gross margin.
The gross margin. It's sitting at a massive 79%. Think about what that means. When they sell their services, almost 80 cents of every single dollar is left over to cover their operating costs and, eventually, become profit.
That margin level is spectacular. For a digital direct consumer business, high margins are basically the holy grail. It proves the model can scale.
It does, and you take that massive margin, you couple with the fact that the company is actually profitable, reporting $15.8 million in net income, and that becomes the whole counter-argument to the bears.
Right.
These are the signs of a healthy, rapidly scaling business, the kind institutional investors usually want to own for the long run.
Which leads to the big question. If they have 49% revenue growth, 79% margins, and they're profitable, why did we start this deep dive with a 6% drop? Why are a third of the shares being bet against?
What's the sophisticated bear argument?
Yeah, what are they seeing that we're not?
This is where the market narrative gets really complex. The immediate trigger for that drop was a technical miss. The company's earnings per share, or EPS, missed analyst projections by a few cents.
A few cents. With 49% growth. That seems, I don't know, overly harsh.
It does. But the bear attack is centered on the reason for that miss. The analysis suggests the company's being incredibly aggressive. They're reinvesting every dollar they can back into expansion.
So customer acquisition, new products.
Customer acquisition, new product lines, market entry into huge areas like weight loss treatments. They're actively choosing growth over maximizing their immediate quarterly profit.
Okay, so they're being punished for their ambition. It's a philosophical divide. Do you want a company that squeezes out every penny of profit this quarter for shareholders?
Or do you want a company that spends that money to capture future market share?
Exactly. The short sellers are betting that HIMS is spending too much, that acquiring customers will get more expensive, and that those amazing 79% margins just aren't sustainable.
They're betting the company will hit a wall before the long-term plan pays off.
That's the bet. And that conflict sustainability risk versus aggressive growth is what explains the chaos we see in the valuation. Which is a perfect transition. Let's talk about how this disagreement translates into actual price target.
Because the analyst gap here is one of the clearest signs that no one on Wall Street can agree on what HIMS is worth. And that just adds more fuel to the volatility fire.
And we're not talking about a small 10% difference of opinion here. The range is just enormous.
That's huge.
On the bearish side, you've got major institutions like Bank of America. They recently downgraded the stock with a target of $29.
Right.
But then you look at the other extreme, the bulls and other analysts have price targets as high as $85.
That's a $56 gap. That is massive. It suggests completely different beliefs about the company's market and, crucially, whether those 79% margins can actually hold up over time.
And that lack of consensus, it just creates the perfect storm for extreme price swings.
Which is exactly what we saw recently.
Yeah, the analysis described the recent chart action with a very vivid trading phrase, gap up and crap out. For the listener, what does that technical term actually mean in practice?
It describes a really ugly pattern. It's where the stock opens much higher. HIMS opened near $34, but that upward momentum just instantly fails.
And then the sellers take over.
Heavy selling pressure dominates the rest of the day, pushing the price straight down to close near its low, which was that $31.69. It's a sign that either the shorts successfully defended a key price level or that early buyers just panicked.
Which brings us to the most practical takeaway from all this analysis. The critical price points. The lines in the sand that could determine what happens next.
The analysis identifies the current range as the danger zone, and the single most important barrier, both psychologically and technically, is $30.
$30. So what happens if it holds?
If the price holds above $30, it suggests that the fundamental buyers, the people who believe in the growth story, are stepping in to defend the stock. If it holds, the short sellers are considered trapped above that support, and the squeeze potential remains extremely high.
But if that key $30 support level breaks, I imagine the whole dynamic changes.
It flips completely. The analysis warns that if the stock breaks below $30, stop losses could get triggered, the selling could accelerate, and the next major support level is way lower.
Oh, low.
Potentially down to $24 before you'd expect a real bounce. So that $30 level really is the battleground that dictates everything.
Okay, so let's synthesize this whole picture for you now. The analysis really presents this powerful binary choice. On one side, you have the pure trader's view.
Right.
The massive, crowded 31.39% short interest makes HIMS a structural powder keg waiting for a match. It's incredibly appealing if you're looking for those huge asymmetric returns from a short squeeze.
And then on the other side, you've got the long-term investor's viewpoint. The strong fundamentals, nearly 50% revenue growth, those incredible 79% margins, and real profitability all suggest that this dip could be a steal for patient capital.
Especially if it holds above that critical $30 mark.
Exactly. It's this perfect clash between an aggressive growth story and extreme market leverage.
That tension is what makes this so fascinating to watch right now. It's a real company, a fundamental growth story, colliding head-on with a historic level of short pressure.
And honestly, this case study is so important for learning how to navigate today's markets. You're constantly overloaded with information and volatility, the ability to separate the core mechanics.
Like the short interest setup.
Right. Understanding how a squeeze can ignite and separating that from the core financials is the business itself actually healthy? It's paramount. You have to look at both at the same time.
Absolutely. Don't get caught in the panic, dissect the data. So given that incredible analyst disagreement we talked about with targets from $29 all the way to $85, we have to leave you with one final thought.
That massive gap really is the whole point of friction.
Is this $56 valuation gap simply a sign of total market confusion about the future of digital health? Or is that huge range simply a perfect reflection of the risk premium that's required for a stock that is both high growth and highly shorted? Is the risk